Hey folks, this is David McKnight, best-selling author of The Power Zero and The Guru Gap. In today's video, we're talking about one of the most misunderstood and misused financial tools in the entire retirement planning universe, Index Universal Life Insurance, also known as the IUL. If you believe what you see on TikTok and elsewhere, you'd think the IUL is the silver bullet, the magic fix, the only thing you need to retire rich, happy, and tax-free. But let me be clear from the very outset, that idea is wrong. It's not the silver bullet. And if you treat it like one, your retirement plan might already be doomed. Here's the truth. The IUL is not a stock market replacement. Let me say that again. The IUL is not a stock market replacement. Now listen, I'm not here to bash the IUL. I've done entire videos on the benefits it can offer when properly structured and strategically deployed. But on its own, it is not a sufficient retirement strategy. Why? Because over the long run, your stock market portfolio will vastly outperform the IUL. We're talking average long-term returns in the range of 8 to 10% for a diversified stock portfolio. Compare that to the IUL, which will generally yield somewhere in the range of 5 to 7% over time net of fees. So if you're planning to dump all your retirement savings into an IUL and expect it to carry you through 30 years of retirement, you're setting yourself up for failure. But just because the IUL isn't a standalone solution doesn't mean it doesn't have a powerful role to play. In fact, when used in concert with a 100% stock portfolio, particularly inside of a Roth IRA and/or Roth 401k, it can absolutely supercharge your retirement strategy. Let me show you how this works. Here's the formula I recommend. 70% of your retirement savings should be directed towards Roth accounts, whether that's Roth IRAs or Roth 401ks. And 30% should be directed towards your properly structured IUL. This is your balanced, tax-free retirement blueprint. The stock side gives you long-term growth. The IUL gives you stability and optionality. Now let's fast forward to retirement. Let's say the stock market is down in year one of retirement. If you're relying entirely on your stock portfolio for income and you continue to take withdrawals after that market downturn, you're creating what's known as sequence of returns risk. That's when taking money out of your portfolio after a loss creates a hole so deep your investments may never recover. But if you've built up cash value in your IUL, you don't have to touch your stock portfolio in that down year. You can instead take tax-free loans from your IUL, allowing your stock portfolio time to recover before you take further withdrawals. This strategy is known as using the IUL as a volatility shield. It protects your stock portfolio from being cannibalized in bad market years, particularly during the first 10 years of retirement, which are the most critical for long-term sustainability. Now here's the impact of that one decision. When you withdraw from your IUL in down years, and only in down years, your sustainable withdrawal rate effectively doubles. That's right. Instead of the traditional 4% rule, you can safely withdraw as much as 8% per year. And this isn't just anecdotal. A recent study from Ernst & Young showed that this precise strategy, using an IUL in combination with a stock-based investment portfolio, maximizes retirement income better than relying on stock market investing alone. And yes, you heard that right. Ernst & Young, one of the most respected financial institutions in the world. Their research shows that using the IUL as a volatility shield results in a 95% success rate of sustaining that higher withdrawal rate over the course of retirement. So no, the IUL isn't the silver bullet. It isn't all you need, but when paired correctly with your aggressive tax-free stock market portfolio, it becomes the perfect complement. Let's recap the strategy. Step one, maximize your contributions to Roth IRAs and/or Roth 401ks. That's 70% of your overall retirement plan. Step two, allocate 30% to a properly structured IUL. Step three, in retirement, take your income from the Roth side in most years, but in years when the market is down, take tax-free loans from the IUL instead. Step four, once the market recovers, switch back to your stock portfolio for income. This single decision dramatically reduces risk and maximizes your retirement income over time. And it puts you in a position to weather market volatility with far less stress and far more confidence. Remember, it's not about choosing between stocks and the IUL. It's about using both together in a balanced, strategic, and tax-efficient way. The IUL isn't your main engine. It's your stabilizer, your volatility buffer, your tax-free insurance policy against the bad years that inevitably come. So the next time someone tries to convince you that the IUL is all you need, run in the other direction. The IUL works best, not in isolation, but in harmony with your stock portfolio. It's the 1-2 punch that gives you growth and protection. And when you lay in the tax-free power of Roth accounts and strategic withdrawals, That's when the plan comes together. And one more thing before we go. If you're a millennial or part of Gen Z and you're wondering how to get from square one to financial independence without losing half your retirement savings to taxes, you're going to want to get your hands on my upcoming book, The Secret Order of Millionaires: 7 Principles for Building Tax-Free Wealth. Now, this is the financial parable that lays out the full blueprint for achieving lasting tax-free wealth, coming in May of 2026. By the way, if you'd like help implementing a balanced, comprehensive approach to tax-free retirement that shields you from both rising taxes and market volatility, head over to davemcknight.com and click on the Connect with an Advisor button. I'll personally refer you to an advisor in the Power Zero network that has been trained, vetted, and qualified personally by me. And if you're a financial professional and want to become a certified Power Zero advisor, head over to powerzero.com and opt into my free 3-part video series. And as always, if you have any questions or comments, drop them into the comments section below. I respond to every single one of them personally. And don't forget to click like, subscribe, and the bell so you never miss a video. This is David McKnight. I look forward to seeing you on the next video.